Okay.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Welcome to today's webinar. My name is Matthew Darius. I'll be moderating the call today for NASBO. Today's topic is the establishment and management of district reserves with Don Hoffman and Alan Yu from Cullen Danowski. If anyone has any questions during the webinar, please feel free to hit the raise hand button, and I'll be able to connect you to either Don or Alan. And with that out of the way, Don, go ahead.
Okay, thank you, Matt. This is Don Hoffman. I'm a partner with Cullen Danowski. We're an accounting firm based on Long Island in Port Jeff. With me is Alan Yu, who's another partner, and we also have with us today Steve Lenz, who's our Director of Quality Control. We're actually scheduled to do two presentations over the next several weeks. This one on the establishment and management of district reserves, and then in a couple of weeks there's another webinar based on medium-term financial planning and the actual use and recommended use and issues related to the appropriation and budgeting and use of reserves in terms of calculations and dollars, and trying to help you utilize these reserves in an effective way to help you manage the transition into the new world of the 2% tax cap. Within this presentation, we've borrowed notes that have been provided by Jeff Swiatek. He's a partner with a law firm up in Buffalo, Hoxton Russ. And Jeff had done some presentations on this same subject that had quite a bit of legal information and legal references. He was nice enough to allow us to incorporate that into the presentation. So we just wanted to acknowledge Jeff's help with this. So what are we going to talk about? First of all, we're going to talk about some basic reserve information. We're going to talk about some of the more common or popular reserves. Then we'll get into the creation of reserves, the funding of reserves, have some conversation about the size of reserves at this point, although in a couple of weeks we'll spend a lot more time talking about the size of reserves. How to appropriate reserves. We'll talk about some of the issues relative to the appropriation of reserves, liquidation of reserves. If you have a reserve that you no longer need, how to liquidate that balance, or what's appropriate and inappropriate to do relative to that. We'll talk about encumbrances, which is a form of a reserve, and just point out a couple of details about the use of encumbrances. We're going to talk about some of the accounting issues related to reserves. Some again, pretty basic information on that. Timelines relative to the use of the reserves, and then planning for the use of reserves. And the planning section, and for those of you who have flipped through the slides, is really the beginning of talking about some of the budget challenges that all school districts in the state are well in the middle of, and realistically are going to be more involved in over the next several years. So the way we've got this organized, Alan and I are going to swap on and off in terms of presenting some of the information, just so you don't get too bored listening to one person's voice. So with that, we'll start the actual work. Now, the reserve basics. Reserves must be established as allowed by the law, okay? And that's pretty straightforward. If there's not a legal reserve, that the law allows you to establish the reserve in some fashion, you can't establish it, okay? Most reserve fund statutes expressly declare that the members of the governing board are trustees of the reserve fund, okay, and are subject to all the duties and responsibilities related to that, okay? So when reserves are established, they're established according to being allowed by law. They can only be utilized as used by the law, and the Board of Education is ultimately the trustee of those reserves, and it's an important legal responsibility, okay? As you know, total fund balance basically consists of three factors: restricted funds, which are legally reserved funds, and we're going to go through those funds during the presentation today. Assigned fund balance, which is the fund balance appropriated for the subsequent year's expenditures, and the balance is the unassigned fund balance. Now, for the business officials out there, I can't tell you how important it is for in your district, and when you're dealing with the public and when you're dealing with your Board of Education, to be as consistent and precise as possible when you're talking about fund balance, okay? In some people's mind, fund balance is the unassigned fund balance, and people refer to that regularly. In other people's mind, and in my mind, fund balance is the total fund balance. It's the total equity of the district. It's critical when you are talking to the community and talking to board members and talking to your superintendent that you're consistent in how you use those terms and everybody knows what you're talking about. If you're inconsistent there, it can cause a lot of misunderstanding and confusion that you really don't want to be involved in. The popular reserves list the ones that we're going to talk about specifically here. The capital reserve, which is relatively complex in the scheme of the management of reserves. The tax cert reserve, retirement contribution reserve. Next to each of these, I provided you with the legal reference. GML is General Municipality Law. So if you wanted to see it and read it yourself, you have access to it. Again, the workers' compensation reserve and unemployment insurance reserve, the EBLR reserve, employee benefit accrued liability reserve, obviously a very important one for a lot of districts, and one which has caused some controversy and some confusion over the past several years, so we'll spend some time on that. We want to talk about mandatory reserve fund. And this is interesting in today's environment where school districts are selling properties. The last two, quote, popular reserves on this list, the mandatory reserve fund and the tax reduction reserve fund for the sale of real property, are two reserve funds that districts might not have used historically. They're not used often. You don't sell property all that often. But in today's environment of trying to make sure there's enough funds to run the day-to-day operations of a school district, I would think we're going to see a lot more sales of property, and we may see situations where the mandatory reserve fund and the tax reduction reserve fund will come into play. So I'll talk about those a little bit later on. So now I'm going to turn it over for Alan to talk about the first set of these popular reserves, starting off with the capital reserve.
Okay, thank you, Don. Good afternoon, everyone. The first reserve that we're going to talk about is the capital reserve. Now, this is capital reserve for school districts, and the law that authorizes the creation of the capital reserve is Education Law, Section 3651. Capital reserve is a way for school districts to fund for future capital projects in a systematic way, so that school districts can avoid borrowing and incurring, or thereby reducing or eliminating interest costs altogether. It's going to be more and more popular in light of the current economic situation, and certainly it's a good way if school districts have funds available to set them aside in capital reserve. That way, not only do you have that, can you exclude it from your annual budget, but also help reduce the cost of borrowing. The purpose of a capital reserve, as I mentioned earlier, is to pay for future capital projects. And in the second bullet, you can see there's an appeal, Commissioner's opinion, appeal of Kackmeister from April 2001. That's a very good opinion. It basically lays out all of the important details about a capital reserve and for which you can use it for the cost for which bonds may be issued, and primarily it's basically capital projects. The creation of capital reserve is through voters' approval, and the proposition that is voted upon, it must specify the purpose for which the capital reserve fund is to be established, the ultimate amount of the reserve, the probable term, and the source from which the funds are to be obtained. No rolling balance. Ultimate amount of the reserve fund is the total amount which may be paid into the fund over the entire term. Now, it's important to let you know that the ultimate amount of the funding, it's just the amount that the district can put into the capital reserve. It does not include interest, which has to be accrued. The reserve fund does earn interest, So, for example, if the ultimate amount of the proposition is for $10 million, that's the most that the school district can fund into the capital reserve. However, you may conceivably have more money, more than $10 million in the reserve ultimately because of interest earnings. Also important to know, capital reserve usage of the fund also will require voters' approval. And in the voters' authorization to spend the funds cannot be in the same fiscal year as when the reserve fund is created. Now, for example, if the proposition to create the reserve is in May 2012, the proposition to request or to allow the district to spend from the capital reserve cannot be in the same fiscal year. Basically, the amount of the capital reserve that can be expended is limited to the fiscal year that the voters authorize the expenditure. Now, what does that mean? So say the proposition authorizing the spending from the capital reserve is made in May 2013. That means by June 30th, 2013, the appropriation from the capital reserve has to take place. Now, that would really mean, it's more like a bookkeeping entry, if you will. Once the authorization from the voters is in place by May 2013, then on or before June 30, 2013, you should record the journal entry to transfer the amount of money authorized by the voters out of the capital reserve, which is, of course, accounted for in the general fund, and you move it, transfer it to the capital fund where you can then let it sit there, and so that when the capital projects happen, say over the summer, that's when you can actually spend the money. But as far as the transfer out of the capital reserve sitting in the general fund, that should take place in the same fiscal year that the voters' authorization is approved. So basically, it's two votes, if you will. Okay, there's a vote to authorize the creation and funding of the capital reserve, and a second vote in a different fiscal year authorizing the expenditure of the capital reserve fund. Okay. At the end of the probable term, the fund is essentially defunct, except as a vehicle to hold the accumulated funds, the balance to be spent down by voter-approved propositions. What that means is that the probable term associated with a particular capital reserve, that really refers to the number of years for which you can you can place funds into the capital reserve. If the probable term, let's say for our example, is 5 years, that means you have 5 years to fund the $10 million capital reserve. That doesn't mean that you have 5 years to fund and spend everything within the capital reserve. Now, that probable term refers to the amount of time that you have to fund the capital reserve. And transferring money into a capital reserve and spending it in the same year is an inappropriate use of the fund. That comes from the Commissioner's opinions, and we just talked about that earlier. All right, before we get into the tax certiorari, just one more thing to add to the capital reserve. Keep a couple of things. Once you transfer the money out of the capital reserve in the general fund into the capital projects fund, it retains its character as a capital reserve. So when it's in the capital projects fund, you still have to continue to account for the balance of that capital reserve fund project. The significance of that is that once the capital reserve for which the stated purpose is over, is completed, the capital reserve will need to be disposed of, and therefore it's important to track the capital reserve balance even when it's been transferred over to the capital projects fund. Basically, unspent money from the capital reserve finance projects will then have to be transferred back into the general fund capital reserve pot, and then at that point you can seek voters' approval to dispose of the unspent capital reserve balance. Okay. All right, tax certiorari reserve, also created under Education Law Section 3651. That's where the authority comes from. It's becoming more and more important now, especially with a decrease in property value, and more property owners and homeowners are filing for tax certiorari claims. And for those of you who are in upstate, you've always been dealing with this. Nassau County is fast becoming a reality. Nassau County had passed a local law transferring the responsibility to Nassau County school districts. While that law is currently being challenged, and we don't know what the ultimate outcome would be, but should Nassau County prevail and Nassau County school districts would then have to shoulder that responsibility, that would become a district liability in this current 2012-13 fiscal year. For tax certiorari reserve, Nassau County school districts cannot really establish it until this current fiscal year, and will recommend June 30, 2013. The creation of a tax certiorari reserve, unlike a capital reserve, even though they're both authorized under the same education law section, a tax certiorari reserve can be created simply by board resolution. It does not require voters' authorization for the creation of it. And the expenditures can also be authorized by board resolution without having to go to the voters. The tax certiorari reserve has to be established in the same fiscal year to which the tax certiorari proceedings relate. And the money must be placed in the reserve in that fiscal year, in the same fiscal year. So what that means really is, we'll take the example of Nassau County school districts. June 30, 2013 would be the absolute last day when they can create the tax certiorari reserve, as well as putting in money or authorizing the transfer of money into the reserve. Okay? It has to be in the same fiscal year. Unlike some other reserves where there have been commissioners' opinions talking about the funding of the reserves can take place basically before the tax rates are set. Okay? With tax certiorari reserve, the funding has to take place in the same fiscal year for which the tax certiorari proceedings relate to. And the money put into the tax certiorari reserve can only be used to pay judgment and claims, okay, commenced in the years other than the specified year. May not be used to pay judgment and claims commenced in the year. So it can only be used for that particular year. If it's set up in the 12-13 fiscal year, it can only be used for payment of judgment and claims related to the 12-13 fiscal year. And for the 13-14 fiscal year, you will have to set up another tax certiorari reserve just for that particular fiscal year. And one thing to also remind you, the wording, the language in Education Law Section 3651 specifies that you can use it to pay for judgment and claims. That does not include any administrative or legal fees associated with the litigation of tax certiorari proceedings. Okay, so keep that in mind. And the money placed in the reserve must be returned, any unused money must be returned to the general fund basically after 3 years, no later than the first day of the 4th year following the deposit of the money. So and that's one of the reasons why we recommend school districts to set it up, if you have to set it up really as close to June 30th as possible, because the clock starts ticking once you start depositing the money into the reserve. Okay? You have 3 years to spend down the money, and any money that's not spent is supposed to be returned to the general fund, the fund balance, except for the monies related to proceedings or claims not fully determined or disposed of after exhaustion of all appeals. So if you still have ongoing tax certiorari proceedings, even after the 30 years, if they have not been adjudicated, you can still hold on to that money in the reserve, even though the law said that you have basically 3 years to spend the money. The next reserve is the retirement contribution reserve. think all of you know by now it's only for employee retirement system contribution only, and it's not to be used for teachers' retirement system contribution, which of course is the much larger of the two expenditures as far as school districts are concerned. Obviously important with the recent continued increases in rates. The rates that, the average rates that just came out for the 13-14 fiscal year, the average rate is going up from 18.9% to 20.9%. So it's a 2.0 percentage point increase, meaning you get no tax cap exclusion relief there. However, going up from 18.9% to 20.9% is actually a 10.5% increase. So the rate increases are going to affect your expenditure. It's going to mean obviously much higher costs. So it's important to have a retirement contribution reserve. It will be very useful for you, to say the least. You can establish a retirement contribution reserve by Board of Education resolution. The funding of the reserve can take place only after you have a public meeting with at least 15-day advance notice published in the official newspaper. Expenditures from the reserve can be made without authorization. Can be by a board authorization, by board resolution. And as Don mentioned earlier, we'll talk about the size and use of the reserves later on. Workers' compensation reserve. If your district is self-insured for workers' comp, then you can have this reserve. The purpose of the reserve is to pay for workers' compensation benefits and the expenses of administering a self-insured plan. It can be established by Board of Education resolution, and the expenditures can also be made without voters' approval. And we're seeing more and more districts who are becoming self-insured, and they are opting for the creation of this workers' comp reserve.
Okay, this is Don again. We'll get back into some of the other reserves now. Unemployment insurance reserves. Okay, several of my clients, many of my clients have started to actually utilize the unemployment insurance reserve. They funded it, and now as they've been forced to lay off staff, their unemployment charges have increased substantially, and they're using the reserves that they had established to cover that increase. So that's obviously a use of a reserve, is to to take care of increased costs, and several of my clients have been able to do that effectively. The purpose is to pay the cost of reimbursement of state unemployment insurance fund when the district has elected the reimbursement method instead of the contribution method. So what that means is districts, the vast majority of school districts, pay for unemployment to the state based on actual charges. They're not paying just based on a tax rate the way a business does. They pay based on actual charges. So if your school district is in that situation, you can reserve against future charges for layoffs. Okay, it's a pretty flexible reserve. Obviously, like any other reserve, it can only be used for the purpose for which it was established, which is unemployment insurance. The next reserve, and this is a relatively complex one, and one that's been misused in some places over time, and the Comptroller's Office is identified as a potential problem area, and for which the legislature has provided for the last couple of years with a mechanism to use the Employee Benefit Accrued Liability Reserve for purposes other than what it was initially intended, okay, which is important, right? So it was initially intended, and the law says it's intended, for the cash payment of accumulated and unused sick leave, holiday leave, and vacation leave payable upon termination, okay? So obviously employees, based on collective bargaining agreements, accumulate certain benefits that will be paid out at termination. That's a true cost of doing business for the district, and the law allows school districts to put money aside for these future payments. Now you do that by reserving the funds as part of your fund balance. It's important to know a couple of things about the use of this reserve. It cannot be used for payments that are not based on accrued unliquidated time. Okay, so it cannot be paid if it's a lump some retirement payment. Even if the collective bargaining agreement were to say, at termination you get $20,000, you cannot reserve that. That is not reservable. The accumulated time has to be based on an accrual based on time, not on just flat dollar amounts. Okay? It cannot be used for salary-related payments. Okay? And the related there is the key word. Okay? For example, the FICA costs. All right? The reserve is only for the payments that are going to the employee. It's not for other costs that might be associated with those payouts, and the biggest of which is FICA. Okay? If you have, and you should have, a long-term compensated absences liability on your statement of net assets, your GASB 34 statements, that liability should include all types of liabilities that you might have on termination, which would include FICA, but the reserve is not allowed to reserve for the FICA funds and the related funds. So what that means, practicality, is that in almost all instances, and probably all instances, your reserve for employee benefit accrued liability should be less than your long-term compensated absences liability on your statement of net assets. And it also cannot be used for the district's retiree health insurance premium cost, okay, for retirees' health insurance. All right, so let's talk about this for a second, because this is where some districts got confused, and this is a big issue. Obviously, school districts are going to have a substantial cost in the future for retirement health care. GASB 45 has established some accounting related to that, which for most districts means you're taking your long-term liability and you're recording that liability into your statement of net assets primarily on a 30-year basis. That's what the GASB allowed as a period to add that in. By some states and by the GASB, they talk about the ability to fund that and reserve funds for that. New York State does not have a law that allows school districts to set those funds aside in any kind of reserve or any kind of investment fund. So you cannot reserve and you cannot fund your long-term retiree health obligations. Okay? That said, 10 years ago, in that time period, around those years, some school districts did start to set funds aside for retiree health care costs, and they used the EBLR reserve, the Employee Benefit Accrued Liability Reserve. All right? And what happened is this reserve grew, and it was growing, and it was easy to see that the amount in that reserve was greater than the compensated absences liability because you had two numbers that you could compare. The Controller's Office several years ago identified this as a problem with some school districts. And they said you've overfunded your EBLR reserve either directly for retiree health care or just overfunded it in general. Okay? And that's a problem for the school districts because according to the law, you can only use the reserve for its intended purpose, and yet there's funds in this that are not appropriately reserved. They don't belong in that reserve in the fund place, in the first place. So the issue becomes, how do you use those funds? And that's right here. Some districts have overfunded this reserve. You know where it came from. A lot of it came from the retiree, healthcare, the GASB 45 costs. For the past 2 years, there's been legislation that has basically said if your EBLR reserve is overfunded, which in round numbers means it's greater than your compensated absences liability. And I already said why that's not an exact calculation, but just using round numbers here, you might be able to use that EBLR reserve and return funds from the reserve back to the general fund, into the unappropriated fund balance. Okay? To do that, you needed Controller's Office review and certification. Okay, so you actually had to apply to the Controller's Office where they would review the numbers and then give you permission to do that. And the amount that you could transfer back to the general fund was only the amount of the district's state aid gap elimination adjustment. Okay, so basically what the legislature said is, look, we know a lot of school districts have had this gap elimination adjustment. We also know that some school districts have overfunded their EBLR reserve. We will allow for this 1 year, but they did it 1 year and then they renewed it the next year. But they basically said for this 1 year, we will allow you to transfer funds back from the EBLR reserve to the unappropriated fund balance to be used however you want from there, put it into another reserve, return it to the taxpayer, maintain the 4% undesignated unreserved fund balance, whatever you want to do once it gets in there. Obviously, if you're in this circumstance and your EBLR reserve is overfunded, it's an issue you should be addressing, figuring out how to use it. You can deal with your lawyers, legal advice. You can deal with the controller's office for help on that. But that is, it could be in the district's best interest to free up those funds. Now, that does not mean, in the case where the EBLR is not fully reserved, it's not over-reserved, okay? You do not have any opportunity there to utilize those funds for any purpose other than what it's designated, which is payments upon termination. So there's some flexibility, but it's not free use of those funds in the EBLR reserve by any sense of the imagination. Okay. The next two reserves we're going to talk about are interesting reserves in today's environment. And frankly, I just saw in one of the newsletters that I get, I think the School Board Association newsletter, had a front page article about student enrollment decreases in some counties, in some areas upstate New York, that in 30 years have gone from 22,000 students to 7,000 students. Clearly in those circumstances, and in a lot of places, consideration is going to be given to selling school-owned property, okay? So what happens when you sell this property is you get a one-time infusion of funds, all right? If you sell land that a school building resides on and you have $1 million, what happens to that $1 million? And the first reserve we're going to talk about is the mandatory debt reserve. And the purpose is to retire outstanding debt obligations relating to property sold by the district. Okay, that's the key. So if you're selling a piece of property that you have debt on, right? You borrowed money to build the property or to do some improvements. More likely than not, it's for some improvements that took place 15 to 20 years ago. Now you don't need the property, you sell it, but you still have some debt. You're obligated, you're required to set those funds aside in a debt reserve so you have the money available to pay the debt. Okay? Now, practically, okay, the practical aspect of that is when you have the funds available, you should be appropriating it each year to make some debt service payments. Okay? And that reserve should go down along with the debt obligation related to that facility. It may be that you have to do some calculations as to how much debt is related to a facility sold. So, for example, if you had a $10 million bond 10 years ago that affected 3 properties, you might need to know how much of the debt is related to the one property. Okay? So there might be some math involved and some accounting involved, but the intent is to make sure that you've set aside those funds so that you can make your debt service payments to whoever you own the money to. Okay? The second bullet point, this reserve is mandatory if there's outstanding debt. This is where the money has to go first before it can go anywhere else. It's obviously funded by the proceeds of the sale of property. Okay? And there's no other source of funding allowed for this debt reserve. Okay? This is not a general debt reserve. So what that means is if you have fund balance at the end of the year, you can't just take money from your unappropriated fund balance and reserve it to pay debt. Okay, that's not what this reserve is for. This reserve is to pay for the debt associated with properties that have been sold. Okay. The next reserve is very similar to the other one, but there's some more flexibility with this reserve, and this one is clearly optional based on the Board of Education. So again, in the instance where you sell a piece of property, the district will presumably get a one-time infusion of cash. You sell land in a building for $1 million, you now have $1 million of cash that would otherwise end up in unappropriate unreserved fund balance. It'll be part of your fund balance, right? The purpose of allowing this tax reduction reserve is to allow, through Board of Ed resolution, the ability of the Board of Ed to set those funds aside, reserve them so they don't go back to the taxpayer in any one year, and then use those reserves over a 10-year period as they see fit. Okay? So what you're doing is you're taking the benefit of receiving this cash, and from a tax perspective, from a tax levy perspective, spreading out the deficit, the benefit of it, so that it doesn't have an unusually large impact in any one year. And depending on the needs of the district, it's very flexible. You can use it over 10 years. You can use it in 1 or 2 years. You can stagger the amounts that you utilize based on other revenue sources and other expenditure decisions that are made at the district. But you have up to 10 years to fully utilize that reserve. Okay? And applications for levy may be done without voter approval, which basically says the Board of Ed, through the budget process, can utilize those funds. Okay.
Okay. Creation of reserves. This is Alan Yu speaking again. For the most part, reserves, as we discussed earlier, they're created by board resolutions, with the exception of capital reserve, which I've talked about earlier. And just once again, capital reserve is created through voters' authorization, stating purpose, source of funding, the term, and the total dollar amount. The funding of the reserves, except for the repair reserve, which we didn't talk about earlier, but maybe I'll talk about it in a short while. For the most part, funding of the reserves through board authorization, board authorized transfers from the unassigned fund balance, what we used to refer to as the unreserved and appropriate fund balances. However, transfers into capital reserve must be in compliance with the proposition creating the reserves. As we've talked about earlier, the proposition authorizing the establishment of the reserve must also include the funding sources of the reserve. Transfers into the repair reserve. The repair reserve, there was a common misunderstanding about a repair reserve, thinking that it's very flexible and very easy to use. Not really. The repair reserve, although it can be created by a board resolution, the funding of the reserves actually are subject to voter authorization. And very commonly, that would be accomplished by building into the annual budget a line for funding the repair reserve. Of course, the other alternative is to have a separate proposition to fund the repair reserve. That's why it's really not very flexible, as some people may think it is. With the repair reserve, the usage of money from the reserve, the appropriation from the reserve, also has some sort of restrictions. Basically, prior to spending money from the repair reserve, there has to be a public hearing with at least 5 days of advance notice published in the local in the official newspapers. And should a school district use the repair reserve in an emergency situation without holding public hearings, there is basically a 2-year window where the district must replenish or reimburse a repair reserve for the amount used. And basically, the first year the district would have to replace at least or reimburse the repair reserve by at least 50% of that emergency funding. So we don't see too many school districts now using repair reserve. There are a few, only a couple that are still utilizing it. And if you are one of those districts, just pay attention to the requirement as far as the funding as well as the spending out of the repair reserve.
Okay, this is Don again. We're going to talk a little bit about the size of reserves and what's reasonable. And the slide after this talks about some limitations on the reserves. But the Controller's Office has basically said reserves should be reasonable, okay? And the total balance, the reserve, the funding reserve should be based on an analysis of the balance in the reserves and the future requirements. Okay, so something like the workers' compensation reserve, you can support that through an actuarial study or insurance reports that says here's your your claim balance and potential claims or what you might have to pay out. In our presentation in a couple of weeks, we're talking about planning, medium-term financial planning. We're going to spend some more time talking about the size of reserves and appropriation strategies for the use of these reserves. But here I just want to talk a little bit about the basics. But I do want to talk about the ERS reserve, okay, because this is one where there's been, in our mind, the analysis and use of this has not really been very sophisticated, okay? So, what's happened with ERS? And if anybody's looked at a chart or a graph of ERS rates in the past 25, 30 years, it looks like a U, okay? It's a wide U. Back in the 70s, these rates were similar to where they are now, up around 20% or so. And they reduced over time to very, very low rates through the 90s and the first half of in the 2000s, where the rates were 2-3% a year, very low. And now they're back up 16, 18, 20%. So if you can see that on a graph, it's a giant U. So the question became, what is a reasonable ERS reserve? And some, at least on Long Island, some guideline came out that said, well, 3 years worth of ERS costs is a reasonable amount, and that sort of became an accepted amount. The problem with that as a theoretical basis is that at the time, ERS rates were 2% of salaries. So, for example, if you had 3 years worth of ERS, 3 years at 2% is 6%. So you've effectively reserved 6% of salaries. That doesn't help you very much when rates have gone from 3% to 20%, okay, in a relatively short period of time. That's an increase of 17% of salaries every year, and you only have a total of 6% of salaries reserved. Okay, so unfortunately, it's too late to substantially increase those reserves prior to the increase in the ERS rates. They've already happened. But I would point out to you now that I think this is a very flexible reserve. Okay, you can use it only for ERS costs, but the reality is you can use it to offset any amount of your ERS costs. It doesn't have to be to offset the increase. So the use of this reserve can be very flexible, has to be managed properly, but it's flexible. Okay, and I'd recommend looking at the reserve as being 3 times the historical average rates if you want to use that, which would be 30% of salaries. Okay, some number like that is certainly justifiable in today's environment, and not knowing what the future brings. So again, there's quite a bit of flexibility there. So the size of reserves, as we said, should be reasonable, should be based on some analysis. 3 limitations we want to bring to your attention. The total funding of the capital reserve is restricted by the amount and the term stated in the proposition creating the reserve. So when you had the proposition creating it, 2 of the factors were how much can you fund and what period of time are you going to fund it. So it might have said we're going to fund this up to $10 million over 10 years. That's the most that can go into it, and that's the time frame that the money can go into the capital reserve. The use of that reserve in terms of a transfer to the capital fund can only be made after voter approval, and that can be done after the time period. Okay, anytime during the time period, anytime after the time period. But the funding of the reserve must be completed as in the time frame indicated. Okay, size of reserve, the transfers into the tax cert reserve can only be made in the same year that the corresponding claims are made and must be returned after 3 years if not utilized. Now, if at the end of the 3 years you have specific cases that are still open, you can maintain those funds. All right? So the practical aspects are in the year that you're establishing the tax cert reserve, you're probably using an estimate based on some historical analysis of what reserves are required. Okay? that's fine to utilize it in that fashion and to fund it in that fashion. However, by the end of the third year, the reserve should be for specific open claims. Okay, there should be limited in number, hopefully, and you can get a handle on it. If you're in a situation where you have so many open claims that you're using some analysis after 3 years, you're in a difficult spot, frankly, and you need to understand that. Okay. And then the third limitation is the employee benefit accrued liability reserve should not exceed the total compensated absences liability. Okay, and when we say the total compensated absences, we mean on the GASB 34 statement of net assets, the long-term liability for compensated absences. There are some differences which we note between compensated absences liability and the EBLR reserve. So you need to adjust for that when you look at it. But if your EBLR reserve is substantially higher than your compensated absences reserve, you've got a potential problem. You've overfunded in some fashion that needs to be addressed, at a board level ultimately. Alan?
Okay. How do you appropriate reserves? Expenses related to a reserve are not charged directly to the reserve. Okay? They must be charged to an appropriation instead. So, for example, let's say utilizing retirement contribution reserve for ERS contribution expenditure. Oops, I think I jumped ahead. Okay. Appropriation of reserves can only be for the stated purpose of the particular reserve. All the previous reserves that we talked about. Transfers are generally made pursuant to either voter-approved budget or board-approved transfers for unanticipated contingent expenses. What that means is typically as more and more districts are really budgeting for using appropriate reserves as part of their budget funding sources. Much like appropriate fund balance, more and more districts are now using appropriate reserves as a funding source as well. And we talked about earlier the exceptions for capital reserve, which is pursuant to voter-approved proposition, and the repair reserve that I just touched on earlier. Now, also to use a reserve to fund for expenditure can be for unanticipated contingent expenses. Very often, sometimes we actually see school districts where they knew that they have certain costs. Let's say workers' comp, and yet they would on purpose budget a zero amount in their appropriation. And then in mid-year or in early part of the year, they'll go to the board and ask the board to authorize a budget amendment, essentially, to withdraw money from their workers' comp reserve to pay for the workers' comp expenditures. Now, the problem here is that your budget should really be your best estimate of your total expenditures. You knew that you have workers' comp expenditures, so to budget, put a zero amount in the budget in the appropriation line for workers' comp, and so that your total budget to budget increase from one year to another does not appear to be as high. And then later on in the fiscal year to then request the board to increase your budget by utilizing the reserve is really not an appropriate way to budget or to use a reserve. Okay. The reserve really should be for unanticipated contingent expenses. If all of a sudden you have a substantial workers' comp claim that came in, well, that's a different story. That's previously unanticipated, and now you have the opportunity to go to the board and request the board to authorize the appropriation out of the workers' comp reserve to pay for that unanticipated contingent expense. So that's the key. So either you include appropriate reserve as part of your original budget, just put it in there, put down the full amount of the estimated expense in the budget, and perhaps put down a partial amount of appropriate reserve as the funding source. Or you can use a reserve really for unanticipated contingent expenses. All right. Expenses related to a reserve are not charged directly to the reserve. Rather, they must be charged to an appropriation, and the reserve is used to fund the appropriation. We've come across this quite a bit as we audit school districts. Very often, school districts would just charge the expenditure directly against the reserve account. Okay, I'm talking about on their balance sheet accounting-wise. Well, since the board authorized $100,000 to from the workers' comp reserve to pay for this unanticipated claim, I'm just going to charge the expenditure directly against the reserve. Okay, that's where the authority came the funding of the expenditure is coming from. Well, not really. It's still an expenditure. This extra $100,000 is still an expenditure. It's still supposed to be charged against the appropriation. The authority from the board resolution is authorizing the amendment, the revision to your budget, so that you can increase the budget to accommodate this additional unanticipated expense. So accounting-wise, you should still charge it as you pay the claim. You should charge the extra $100,000 as an expenditures, and then you should transfer the corresponding amount, reducing the reserve, but transferring the amount into your unassigned fund balance, so that at the end of the fiscal year, when you close out the revenues and the expenditures, you now have the available funds in the unassigned fund balance to absorb this additional $100,000 expenditure. Appropriation of a reserve should be done in a transparent manner. Okay. Usually appropriation is part of the annual budget, just like what I talked about earlier. The most transparent way really is to include it right in the annual budget, telling the voters how much you plan to appropriate from the reserve. However, mid-year budget revision is also allowed if the expenses were truly unanticipated contingent expenditures, and obviously you would need a board resolution to authorize that. Next topic is the liquidation of reserves. If the board decides at some point that some of the reserves are no longer needed, here's an example. If the district chooses to go from being self-insured for workers' comp to now becoming premium-based, and they just basically paying the insurance premium, then the workers' comp this workers' compensation reserve would no longer be available to the district. And in that situation, the reserve can be liquidated by board resolution, and pretty much within general municipal law and education law, it spells out the various avenues to which the liquidated reserves, the funding from the liquidated reserves can be transferred. Pretty much you can transfer the funds to any other reserves. And my recommendation is to go to the specific section in the law, whether it's general municipal law or the education law, and look up that particular section for the proper guidance. And by the way, the State Comptroller's Office has also issued a guideline there, a guideline to using reserve fund, and it's a very good reference material, and it's certainly available at the OSC website. And you can see at a glance, what some of the legal aspects of all those reserves are, including how to properly liquidate a reserve and transfer where you can transfer the unspent funds to. Encumbrances, this obviously is not really a reserve. It used to be called reserve for encumbrances on the financial statements before GASB 54 became effective during the 2010-11 fiscal year. But we felt that we should talk about it nonetheless, encumbrances, because you continue to have to account for encumbrances within your general fund. It now is reported as an assigned fund balance rather than a reserve fund balance. The reserves are now considered restricted fund balance, of course. Okay. Encumbrances need to be an actual commitment at June 30th. That means the vendor must be must be identified, and the purchase orders must really be issued and delivered to the vendor on or before June 30th, on or before the fiscal year ended. And everything should be done in compliance with the district's purchasing policy. You cannot set up a dummy purchase order and say, well, I think we're going to go with ABC company, but we're waiting for the bid opening, which is not going to happen until the first week of July. But I have a feeling, since we only received 2 envelopes, and I know those 2 vendors, ABC is going to come out to be the low bidder. So why don't we just set up a dummy PO so that we can set aside money in encumbrances by June 30th. That's not acceptable. That's not appropriate. In order for it to be a valid encumbrance, it must be an actual commitment by on or before June 30th. Okay. And it also should not be an expenditure. Okay. Now, what does that mean? An encumbrance is an open commitment. If you have not received the goods or services that you requested, that's by June 30th. That's a valid commitment. However, if you have already received the goods or services, it's just that you have not received the invoices for it, for the goods or services, you have already incurred a liability, and that means you really should close out the encumbrance, the open PO, and record an accounts payable so that you can record the expenditures in the proper accounting period, rather than carrying it over into the next year as an open encumbrance. And what that would do is essentially moving the expenditures into the next fiscal year. Year-end encumbrances should be liquidated really within the first portion of the succeeding year. Generally, there should be no prior year's encumbrances by the end of the current year. Very often, we would go into a school district and do an audit. We'll look at the open purchase order list, and we would see a number of open POs with dates that are PO creation dates that are more than a year old. Well, really, the year-end encumbrance, really it should be, the commitment should be fulfilled within the first few months, really, of the next fiscal year. If it's gone a year without being fulfilled, then you got to ask the question, is this really a valid encumbrance anymore? Are you not, as the business official or the business office, are you not receiving the proper information from the requisitioner? Maybe they actually canceled the order and you didn't know about it. But really, there shouldn't be any old prior encumbrances by the end of the current fiscal year.
Okay, this is Don again. There's just one slide on a couple of accounting issues related to the reserves. Some districts have set up separate bank accounts for each specific reserve. It's not required, but what is required is the last bullet point. There must be a discrete accounting for all reserves. So generally, if you're recording, the funding of the reserve, the appropriation of the reserve, that's the discrete accounting. The second bullet point talks about interest earned on the reserve. So even if there's not a separate bank account, the fact that you have a balance in the reserve means that you should be allocating some accrued interest into that reserve. It's an easy thing to do. It takes a little bit of math at the end of June to do a journal entry to take some of the funds from interest earned and allocate it to the various reserves that you have set up. It's pretty straightforward, but it's one that, from an audit perspective, we see occasionally doesn't take place. Okay, timelines related to reserves. And this information comes from various sources, but the idea is that for most reserves, okay, and the Commissioner's opinions have said this, that the reserves need to be set aside by the setting of the tax levy. All right. So so what's happened there? You go through your fiscal year, you go through your close, you make your final journal entries. By the time that takes place, it's August or September. In some places, the tax levy has to be set as late as October. So that allows time in that time period to understand what your final fund balance is. Your audited fund balance at the end of the year. It lets you know how much is above if any, is above the 4% unassigned fund balance, right, that you can legally maintain, and the balance either has to go back to the taxpayer or has to go into reserves. So the commission has said their opinion is they understand that time frame, and as long as you set the funds aside by the tax levy, you're in compliance with the laws, right? Other people say that by June 30th, you need to have the funds set aside. And there, what the thought process is, by June 30th, because you won't have an exact amount, you should have the authority to transfer round number estimates or not to exceed estimates into the reserve funds. And that can be by board resolution prior to June 30th. Okay? We talked about earlier the tax cert reserve has to be funded by June 30th. You have to, know how much you want to set aside, prepare the journal entry, and have that processed by then. Okay? Okay. These last few slides are sort of a precursor to some of the things we're going to talk about in a few weeks, which is fund balance management, use of reserves, etc., which is obviously going to be a big change in the way school districts do business, right? But over the past few years, districts have not been able to budget for programs, but have been able to build appropriate reserves and contingencies into their budgets, okay? And I'm currently calling this the good old days, okay, is when there was enough room in your budgets so that even if you appropriated some fund balance and or appropriated reserves, your fund balance still grew year over year. By fund balance, I mean the total fund balance, okay, would grow year over year. So you were able to just roll over the appropriations. Everything was good, okay? When districts didn't spend all their money, they put it into the assigned fund balance and for the subsequent year's budget. But again, back in the good old days, they never utilized any of it, okay? They would still run a surplus. Those days have changed. Obviously, budgets have tightened up, and now we're seeing fund balances that are being reduced quickly. In some of our clients, we're seeing alarming reductions in the total fund balance. We have some large districts on Long Island, but when you're seeing fund balances decrease, and not because of one-time charges, because of just ordinary ongoing expenditures, when you see fund balances going down year over year in over $10 million, and in another case, $7 million, these are alarming numbers and amounts of money. And we'll talk about that a lot more in 3 weeks. But one of our recommendations here is that you need to have a strategic plan, okay? And, in our mind, a strategic plan means 3 to 5 year projections. And on this point, the Controller's Office, you may know, if not, it's right on the front page of the Controller's website. They're in the process of trying to develop a early warning system for the level of financial stress that a governmental agency is under. And they've come up with calculations for governments and a calculation for school districts, 2 different calculations. But the intent is to develop a score. The lower the score, the better. It's like golf, okay, of how much financial stress that governmental agency is under. And based on the number assigned, you'll be classified, or a government would be classified, or a school district will be classified as significant financial stress, in good shape, okay? And I'm paraphrasing there. But it's important for you to be doing 5-year plans so that you can develop your own early warning system of where you are. My recommendation here is to, you just probably, most of you have your audited financial statements. Look at last year's actual results and focus on actual. How much is actual revenue? How much is actual expenditures? How much did you actually use of your fund balance to fund last year's operations, okay? And understand that, okay? Understand what happened last year. You have the audit numbers right in front of you. Make sure that you understand that. There could be, one-time adjustments that are necessary to make to that, but I think it's very important for the business officials to understand actuals, okay? For so many years, everybody thinks budget, 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 but as budgets get tightened up, okay, and surpluses are no longer generated within the budget, you're in a different financial environment now, and I think you've really got to start understanding actual to actual projections, okay? So within that, you've got to look at trends and projections, okay? State aid and other revenues, right? What's happening to your expenditures? And expenditures, you need to break it down, and we're going to go over this in 2 or 3 weeks. Break it down into some meaningful categories, right? Salaries. I would list all of the benefits individually and come up with different growth projections for each of those different categories. The everything else category, you can probably put down 0 growth because there won't be any money to fund any of it for the most part. Supplies, equipment, things like that. But areas like benefits, you can make, certainly estimates for next year, ERS, TRS, healthcare, you'll be able to make those estimates, right? You know what your fund balance is, building up and usage of the fund balance. Enrollment projections should be, a significant consideration. And then obviously the gorilla in the room is the tax cap implications, okay? That's going to have a, a definite impact on the revenue side of balancing your budget. Budgetary trends, okay? Districts have historically built up contingency within budgeted line items, all right? And the best example is special education. Special education, most budgets that, that we've seen over the years had $300,000 contingency for the family of special ed kids, one family that moves into the district, okay? That contingency in most districts has been removed from the special ed budget, okay? Because if they left $300,000 in the special ed line item, potentially 3 teachers would have to lose their jobs, right? So all over the place, your budgets, your expenditure budgets have been tightened up. And the impact of that is you won't have the surpluses that you had before. Now, one of the ramifications of that is districts will then have to deal with the issue of what happens when you really do have an unanticipated contingent expenditure. How do you fund that? And clearly, we've seen in this past audit year, several of our districts have begun to use the 4% unassigned fund balance to fund it. Back in the good old days, they would do a transfer from one line item to another because there was enough room in certain line items to be able to transfer into another line item to cover an unanticipated contingent expense. But as the budgets have tightened, there may not be room within the budget. So districts have begun to actually have to do a budget revision to appropriate some of the unassigned fund balance to create a funding source and to increase that expenditure so they can cover the expenditure. We'll talk more about that in a couple of weeks, but that's something that you should be aware of as things pan out over the next couple of years. The obvious effect of the trend in the budget is that within the next few years we'll no longer have the security of having contingency in the budget and having adequate reserves in order to pay for the significant unanticipated expenditures that might arise. All right, there's some real risk in that with many school districts. Okay. The next bullet point just talks about that you need to be careful about using those surpluses. The cumulative effect of the situation in school districts will probably result in minimal total budget surpluses. Okay, the days of surpluses and funding reserves in a lot of districts are over. One of the key areas there that you can sort of take a look back and laugh is 3, 4, 5 years ago, most school districts were of the opinion that they wanted to fund their GASB 45 liability. And people at meetings would say, oh, we should be able to fund that. Why can't we have a law that allows us to reserve funding for GASB 45? I haven't heard anybody ask for that for the past couple of years because, frankly, there's no money available to fund it. Okay? So the days of that problem are gone. It's not a practical problem anymore. But that's just an example of where things have changed. Okay? So you want to be able to put money into reserve funds where you have the flexibility to use it as you move forward. That requires some medium-term planning. The reduction of fund balance and reserve is an obvious consequence of the property tax cap, and I'm going to show a couple of slides in a minute that will illustrate this. But obviously, if your revenues are growing 2.5% to 3% per year on the tax side, and 2 to 4% on the state aid side, and your expenditures are growing faster than that, you're going to have a reduction of your fund balance. All right, that's just math. Okay. The other obvious ramification is that ultimately, unless you have a taxpayer base willing to vote for piercing the cap on some regular basis, you will have cuts in staffing and programs. Okay, in some cases, expenditures. One of our clients here on Long Island that's been running a deficit for a couple of years is talking about a $10 million expenditure cut for next year. All right, it's a big district, but that said, it's not that big. $10 million is going to have a significant impact on programs. And I think they're just at the forefront of what's going to be happening in many, many districts in the state. The second bullet point here, obviously if districts want to continue to include contingency within their budgets, they'll have to cut spending even more. So, we're talking about either eliminating contingencies from the budget, the $300,000 in the special ed budget, or reducing costs. In an awful lot of districts in New York State, the easy, and that's in quotations, the relatively easy cost cutting has taken place. Clerical staff have been reduced to half-time. Assistant principals at the elementary schools are now 0.5s at each school. Supply budgets have been slashed. Those things have happened or are in the process of happening. Those are the relatively easy ones. The next level are going to be staffing and program cuts, which will be substantial. Now, the next couple of slides is just here, as a visual representation of what problems you're facing in the district. And basically, all this shows in this slide is what happens to a district that in 2011 the revenues are slightly higher than the expenditures. All right, and in this case, revenue is real revenue. It's outside revenue. It's not appropriated fund balance, and it's not reserved. This is revenue from outside sources. So in this example, in 2011, the district ran a surplus, and presumably the total fund balance increased slightly from 2010. You had more revenue than expenditures, okay? But this shows pretty quickly over a number of years what happens, okay? And it's only common sense, but it's visual. What happens when your expenditures increase faster than your revenue, okay? And pretty quickly you start to generate, substantial annual deficits and substantial cumulative deficits. Now, the cumulative deficits can be absorbed by fund balance to a point. But what also happens at a point that your annual operating deficit becomes very, very large, and you've got to get out of that cycle. All right. This similar with different rates. Okay. Here, the delta between revenue and expenditures grows faster, and this one grows faster yet. And you can't see it real clearly, but the red line has a very little curve to it, which means it's exponentially growing faster. These are problems. So these are just here as sort of a heads up. You should look at your own numbers in this fashion, knowing actual to actual outside revenue, actual expenditures. If you have to make adjustments for year over year, you can do that. But you need to know the numbers in your district and think about how to present those in a meaningful way. At the end of the day, the effect of reserves, would be most districts have, historically appropriately created, funded, and used reserve pursuant to the law. The one exception to that potentially is the EBLR reserve, which quite a few districts did not utilize properly and over-reserved it for its intended purpose. Okay, The last bullet, since the trend will probably be more activity within the reserve, particularly on the appropriation side and use of the reserves, you really need to be focused on that you comply with the law, and then also focus on the planning aspect of using these reserves. Again, in a couple of weeks, we're going to talk more about this, the actual use of reserves and the funding, and some strategies that you can use to help develop a medium-term plan, strategies to utilize reserves within the law and to use them appropriately and to move forward. So that's it. Matt, if there are any questions, we've got a few minutes to take some questions.
Okay, if anyone has any questions, I'm echoing here, sorry. Go ahead and type it in, or you can hit the raise your hand button, and they'll notify me of a question. I'll put you through to Don. All right, we have a question from Sandra. Sandra, do you have a microphone up to your computer? You'll be able to ask a question.
No. I'm wondering about the liability and insurance reserve.
Okay. What's your question? Do you have a specific question about it?
You just didn't mention those, I guess.
Yeah, it's very uncommon, relatively uncommon. I won't say very uncommon.
I guess I'm thinking how you get the funds out of those reserves if they were no longer needed.
Well, frankly, we're looking right now at the controller's document on reserves, okay? And on page 21, it talks about the purpose of the reserve, right? So it's to fund certain uninsured losses, claims, or accidents which the local government is authorized or required to purchase or maintain insurance, okay? So it has to do with a loss related, your share of a loss, the uninsured portion of a loss that you might incur under various types of issues, okay? So
so basically, you can use a reserve if you have, if you have losses that cannot be insured. And from our experience, we haven't really seen, even though districts may have money set aside in an insurance reserve fund, the reality is, you are well covered by insurance, by liability insurance, and all kinds of other insurance policies that, it really is very, very rare that you would have any losses that would not be insured. Okay, so we don't really see, at most that you can use it to use really is to use it to cover your deductible, if there is any.
I guess I wonder if you have money in that kind of reserve and you decide that you need the money because you don't have enough regular reserve fund balance. How do you get it out of that reserve? How do you exhaust that reserve?
Then you can go to the Board of Education and basically certify that, number one, that you no longer have any liability as far as this insurance reserve fund is concerned, and basically requesting the board to authorize the liquidation of the reserve. And typically this is Alan Yu speaking, by the way. Like I mentioned earlier, specific sections within the law that governs all these various reserves do allow the Board of Education to, upon liquidation of the reserve, to transfer part of all of the balance remaining to other reserves, within the GML Section 6 or education law, with limitations specific to those reserves. So that's the way for you to get the money out of the insurance reserve or the liability reserve. If you find that you really have no use for that, is to have a formal board resolution to liquidate a reserve.
You do.
You're welcome.
Okay, thank you, Sandra. And we have a question from Tom Lawfer, I thought I saw here. Tom, do you still have a question?
Yes. Oh,
Go
muted?
right ahead.
Can you guys hear me?
We can.
Okay. Yeah, question on the retirement contribution reserve. And the bullet point, funding of the reserve after a public hearing with at least 15-day notice in an official paper. And I wasn't aware. When I read the law, it seems to me that that really speaks to transferring out of another reserve into the retirement contribution reserve. And I guess maybe I just needed some clarification.
Can you hear me, Tom?
Yeah, yes.
Hello? Okay. So in Section 6, in GML Section 6R for Retirement Contribution Reserve, Subdivision 3B, this is what it talks about. There may be paid into a retirement contribution reserve fund. Okay, and then it talks about various areas of funding by budget appropriation or revenues that are not required by law to be paid into the funds. And also, notwithstanding any law to the contrary, such amounts as may be transferred from a reserve fund into the retirement contribution reserve, provided that such transfer should only be made by resolution adopted after a public hearing. So you're absolutely right on that. It is specific to the transfers of from other reserves. So thank you for asking the question and clarifying that.
Okay, just to clarify, a board resolution can authorize the funding of that reserve if it's just simply under 3A, B, or C.
Right.
We would agree
of
with
the
that.
law.
Right.
Okay. All right.
Yep, good.
Right. So for instance, take Sandra's example earlier. If your district is going to liquidate insurance reserve and the liability reserve, and you're thinking about, like we talked about earlier, retirement contribution reserve is very useful now. And if you want to, if the board wants to then transfer the balance of the two liquidated reserves into retirement contribution reserve, so in this case, you must have a public hearing on that, and with 15-day prior published notice in the official newspaper.
Thank you. One more question on the mandatory debt reserve. And I guess it's just, you're right, we're seeing in our area schools closing an elementary school and planning to sell that building. And I just, I guess state aid implications when there is debt outstanding on that particular building that is sold. Because your bullet makes reference to federal and state aid received on account. I just wondered if you could clarify that.
Yeah, it's, that's, what the law says related to that reserve. The practical ramifications is that the district should contact, state ed in those circumstances and get their assistance in their specific case as to where they are in the state aid related to that construction, notifying, state aid that that's taken place, and it may have an impact on the state aid. And that's something I think a district should work directly with state ed on to make sure that they get that right. We wanted to bring it out to your attention that that's a potential issue.
Okay.
Okay, and as you said, as this becomes unfortunately more and more frequent, there'll be more history and people will get a better sense as to what might be involved in that. But for purpose of this presentation, it's important that the district be aware of those ramifications.
Thank you.
Sure.
Okay, thank you. If anyone else has another question, please go ahead and either type it in the chat or hit raise your hand. We'll put you right through to our presenters. Okay, Don? No, we have no other questions. Thank you very much for presenting today. To all the attendees, Don and Alan are presenting again on the 31st on midterm financial planning. So if you haven't already signed up, please do so. And that will conclude today's webinar. Thank you all for attending.